Hello everyone, welcome. In today's video, we look at what is Modigliani and Miller approach. Modigliani and Miller approach is one of the capital structure theories which is used. So when I say capital structure is nothing but how a company or a firm finances its assets, how it uses debt or equity to finance its operational activities. It can either use only debt or only equity, or a mix of both debt and equity. So this approach was propounded by Modigliani and Miller in the 1950s. So they came up with this approach to say that there is no impact of debt in the capital structure, and that does not have any impact on the value of the firm and the overall cost of capital. So this approach advocates capital structure irrelevancy theory. Because debt does not have any relevance on the value of the firm, it is called irrelevancy theory. So this approach can be explained using two prepositions. The first one is without taxes and the second one is with taxes. When taxes are included and when taxes are not included. As any other theory, this theory also came up with certain assumptions. So first assumption is there are no corporate taxes. As I said in the first proposition, there was no taxes included. So there are no corporate taxes. The second one is transaction cost does not exist. When a person or an investor buys and sells equities or any shares in the market, there are certain costs incurring. So here, those transaction costs do not exist. The third one is capital market is perfect. When I say capital market is perfect, that anyone can enter and exit the market at any point of time. There is no flotation cost. So when a company goes public, it incurs certain costs. So like legal charges and etc. But here they assume that there are no flotation costs. The last one is all earnings are distributed as dividends to the shareholders. So for example, if a company is earning 3 lakh rupees income or 3 lakh rupees profit, the whole amount is given in the form of dividends to the shareholders. Nothing is retained in the firm. There is 100% payout ratio here. So we look at the first preposition, that is without taxes. So this is similar to NOI approach. When I say NOI is nothing but net operating income approach. So net operating income approach states that there is no impact of debt on the value of the firm. If debt is included in the capital structure, that does not affect the value of the firm and the overall cost of capital. So in the absence of taxes, the cost of capital and the value of the firm are not affected by the capital structure. The approach argued the financial leverage has nothing to do with the overall cost of capital. So when I say financial leverage, it is nothing but the borrowing or the debt component. So the debt does not have has nothing to do with the overall cost of capital. And financial leverage has no impact on the market prices. See, market prices are obtained by operating profits. It is not determined by the debt usage of debt in the capital structure. So this approach provides operational justification through arbitrage process. Now, what is arbitrage process? See, any individual has this mentality that when the prices go up, they tend to sell things, and when the prices come down, they tend to buy things. So the same the investors keep in mind. So when the share prices of a particular company goes up, they tend to sell those shares, and when the share prices of a particular company comes down, they tend to buy more shares of that company. This process is called arbitrage process. So it is the process that facilitates the individual investors to buy the investment at a lower price in one market and sells them off at a higher price in another market. So we'll replace the word market with the word firm. So it is the process that facilitates the individual investors to buy the investment, as in the shares, at a lower price in one firm. When the prices are lower, they buy shares in one firm and sells them off at a higher price in another firm. So this is called arbitrage process. So arbitrage process, when I say firms, there are two types of firms. You have levered firms and unlevered firms. Value of levered firms and value of unlevered firms can be brought equal through arbitrage process. Now, what is a levered firm and what is an unlevered firm? Levered firm is when debt capital is included in your capital structure. When debt is included in your capital structure, that type of a firm is called a levered firm. When debt is not included in the capital structure, it is called an unlevered firm. So let us take an example of two firms. For one firm has debt capital and in its capital structure, and another firm does not have debt in its capital structure. So these types of firms are called levered and unlevered firms. So the second proposition came up because now Modigliani and Miller thought, what if they reconsider and include taxes? So that is how the second proposition came. So second proposition is with the taxes. This proposition is based on net income approach. So net income approach is nothing but when the debt is included in your capital structure, it definitely has an impact on the value of the firm and the overall cost of capital, because it has an impact or it affects the value of the firm. This theory is called the theory of relevance. So Modigliani and Miller agreed that capital structure will affect the cost of capital and the value of the firm if the company uses debt preposition in its capital structure. When I say use debt preposition, it is not completely or use more debt or take more borrowing. It has a certain margin. If you take debt, if you include debt to that particular margin, there will definitely be an impact or it will definitely affect the value of the firm. This is because the interest paid on debt is taxable, so the tax deductible. So when interest is paid on this debt, which is included in the capital structure, that interest is tax deductible. So taking advantage of this situation, they say that the value of a levered firm will be higher than the value of an unlevered firm. So levered firm, as you know, as I said, levered firm is where debt capital is included and is higher than unlevered firm where debt capital is not included. So in preposition 1, they basically say usage of debt has no impact on the value of the firm. But in preposition 2, they say that the value of a levered firm, which includes debt capital, is higher than the value of an unlevered firm, which does not use debt capital. So this can be explained using two formulas. The first one is value of unlevered firm. Value of unlevered firm is where there is no debt capital used. So as you can see in the formula itself, there is no dividend or there is no debt included here. So value of unlevered firm is represented by VU. So VU is equals to EBIT, that is nothing but your operating profit, divided by KO, that is nothing but equity capitalization rate, into 1 minus T. T is nothing but the tax rate. The second one is value of a levered firm. This is represented by VL. So VL is equals to VU plus tax into dividend. So here you can see dividend is included. This can be further explained through an example. So let us take an example here. There are two firms, two identical firms, that is X and company X and company Y. So company X does not use any debt in its financing, whereas company Y has 1 lakh 5% debentures in its financing. So because company X is not using any kind of debt in its financing, it is called an unlevered firm. And company Y, because it's using 1 lakh 5% debentures, it's called an unlevered firm. Both the firms has a EBIT of 25,000 and equity capitalization rate at 10%, assuming corporate tax at 50%. So let us work this out. So what are the information we need? We just saw the formulas. So what in that we need EBIT, that is 25,000, KE, that is cost of equity, that is 10%, and tax rate 50%. So substituting this in the formula, the first one we will be doing is value of unlevered firm. So value of unlevered firm is equals to VU is equals to EBIT divided by KE into 1 minus T. So VU is equals to 25,000 divided by 10%. The KE, that is the equity capitalization rate, was 10%. That can be converted into 0.10 into 1 minus T. T was nothing but tax rate and it was 50%. So that is nothing but 0.50. So you will get an answer of 1,25,000. So your value of unlevered firm is 1,25,000. Value of unlevered firm is 1,25,000. Now value of levered firm is equals to VU plus T into D. So VL is equals to 1 lakh VU. We just found out VU is 1,25,000. So 1,25,000 plus T is nothing but the tax rate, that's 0.50, into D was nothing but the debentures, that is 1 lakh debentures. So you will get an answer of 1,75,000. So as you can see here, it is very evident. The value of the levered firm is higher than value of unlevered firm. When you include debt, they say 1,75,000 is obviously more than 1,25,000. So in preposition, so basically to summarize the whole Modigliani and Miller approach, the preposition one of Modigliani and Miller approach says that if you include debt or if you don't include debt, it has no impact on the value of the firm, because the market prices of a company is included, is determined by the operating income of the firm, not by the debt which is included in the capital structure. But they again recognized taxes, and they came up with the second proposition, which says value of the levered firm is higher than the value of unlevered firm. So this basically means if you include debt in your capital structure, the value of your firm will increase more than the value when you don't have debt in your capital structure. So this is basically my MM approach. Thank you.